So I wanted to say a little bit about how T-series works in terms of fitting arch and Garch models in R. So the basic way of working shows some similarities in terms of the rhyme, rhythm and reason with previous R commands that we've been exposed to. Things like when we've used R to fit regression and probability regression models. So the basic command that you have to do in both cases, whether you're fitting an arch model or a Garch model, is Garch. And what you have to do is save this as something. And then as a second step, you have to use the command summary to explicitly command R to show you the results. Okay, so it follows this sort of simple two-step process that we've seen before, where you explicitly tell R to calculate something and then get R to show you the results. Okay, remember R is like a robot. It'll do exactly what you tell it to do, nothing more, nothing less. Then the idea is exactly as we've seen before with these regression and extended regression models. You can formally test for the presence of an arch effect if any of the A1 all the way up to AP terms are significant from the t-test, and you can also formally test for the significance of a Garch effect by testing for the significance of any of the B1, B2 all the way up to BQ terms, again using a t-test. So although this is obviously a harder model, there's quite a lot of repetition in terms of what we've seen before. So to summarise then, the t-statistics for the arch and Garch effect follow on from other topics discussed in the module, so there's a lot of repetition in relation to standard material on the regression and extended regression models. However, there is a notable difference in this case. Okay, so the arch and Garch effect in financial time series are described there as essentially ubiquitous. Okay, so you're very likely to find that some of these low order arch and Garch terms are significant, provided you've got the choice of model correct. Okay, and I think what you're going to see is essentially a multicollinearity phenomenon, in that if you have the order of the model too high, then terms will become non-significant, but if you've got the order of the terms correct, then most of the terms should be statistically significant. Okay, so I'm going to give some additional worked examples of this, but you should sort of see here that whilst these are hard models, and they are hard models, this is where the professional standard analysis of financial time series starts. Okay, there's a lot of repetition in terms of what we've seen before in relation to how the R coding works, and also how you perform and interpret t-statistics in relation to the computed output that R generates. So you're not necessarily constrained to looking at price data from cryptocurrencies, but cryptocurrencies provide something that is certainly very topical and is a natural thing for me to include in the module given my research interests. So the idea here is we've got price data on Ethereum from say August 7th, 2015 to February 13th, 2020, and we want to do the following tasks in R. So firstly, read in the data. This is using the .text file exactly as we've done before in the rest of the module. You need to load the package T-series. T-series is short for time series here, if you haven't done this already. And then what I wanted to do in the first step is fit low order Arch1 and Garch 1.1 models, and then experiment the fitting of a higher order Garch 7.7 model. So the idea here is that for daily data, the Arch1 model and the Garch 1.1 model would have the interpretation that volatility from yesterday feeds forwards and affects today, and the Garch 7.7 model in this instance would have the interpretation that volatility from the previous week feeds forward and affects today. Okay, so in both cases then, whether you're looking at the order 1 models or the order 7 models, there's a financial mechanism here related to the human calendar which explains why you expect this model should ultimately work. So the same process, rhyme, rhythm and reason in terms of the R command and how you load in the data that we've seen before. So the first line of the R code there is a read.table command applied to this data set that is saved in .text format. You might have to change the letter depending on what your USB drive is called. Then the next line counts the number of columns in this data set. The price is identified as this fourth column of this data set, and then we're going to reverse the ordering so it's now in chronological order from oldest to newest. You need to find out exactly how long this price series is. So length price gives you that the length of the thing is 1652 observations. So the log return is then the logarithm applied to the price with the first observation deleted minus the logarithm of the price with the last observation deleted. Okay, and the calculations for the log return will always work in the same way. So this should be a relatively standard way of operating. So it shares some similarities with how we've read datasets into R from the beginning of the module, and should have the same setup every time if we're doing financial examples and examples of reading financial data, financial price data. So model fitting in T-series then. So the basic thing to first bear in mind is that you need to apply models to the mean corrected log returns. So this just means that the log returns with the mean of the log return subtracted. So that is what is happening here with the first line of our code there, the resid term. Then the idea is that we fit Arch1 and Garch11 models to this data. Remember that the R syntax works the other way around to the standard econometric notation. So this is a bit of a pain because really the R code should be organised the conventional way round, but the fact that it isn't actually makes it easier because R's quirkiness here actually makes it easy to remember how exactly this code works. So for the first one then, what we're going to do is apply this Garch command to the series resid that we've identified at the top of the slide, and the order is concatenation 0, 1, so this is a Garch term 0, Arch term 1. And then for the Garch11 model, it's the same Garch command applied to the same residual series. Now it's order 1, 1, so it's Garch order 1, Arch order 1. Okay, and then think R for robot. So what we've done here is the first step of the calculation commands, and we've called it something logical, and then the summary commands at the bottom of the slide to get R to display the results of the calculations. So testing for the arch effect then in this first Arch1 model. So using the command summary in R gives the t-statistics in the table, and the thing to sort of look for here is the coefficient of A1, and what you have is that this thing is significant precisely because the p-value at the very end is less than 2 times 10 to the minus 16, so it's less than 0.05, and when R displays the results, because it's significant, it's accompanied by the asterisk. And what it says here is that using the command summary in R gives conclusive evidence of the arch effect precisely because this p-value is less than 0.05. Then I've tried to give you the example of an exam type hand calculation. It's less important this year. Okay, the only thing I would say is that sometimes these things look cosmetically different compared to when you do the hand calculation and compared to when you just do the computation in R. And then right at the bottom of the slide you've got this little trick about the inequality signs pointing a different way you've done the thing correctly. So the t-value in this case is 11.78, which is much bigger than 2, so p must be less than 0.05. So testing for the Garch effect then, when we've got this Garch11 model, so the results are produced by the command summary, and although this is a harder model and this is beginning to push against the limit of what you can reasonably expect students to do here, what you should see is that there's quite a lot of repetition in terms of the way that R produces the output, and more importantly here, how you read off things like the p-values and interpret the t-statistics. So for the arch effect, you're looking at this A1 term in this table of t-statistics. What you have here at the end is the p-value is significant precisely because the p-value is less than 2 times 10 to the minus 16, and so by extension is automatically less than 0.05. It's also accompanied here by some asterisks, and then for the Garch effect, what you're looking for here is the B1 term, and this is again significant precisely because the p-value is less than 2 times 10 to the minus 16, which in turn is less than 0.05, and you've got some asterisks there to denote the significance. Now I've tried to just give some examples there of a quick hand calculation for the arch effect and for the Garch effect, so that would be more important in years where you sit a formal written exam rather than this year where there's a coursework. Okay, just to point out again, you've got this trick where the inequality signs point a different way. Doing the thing correctly. This is p is less than 0.05. So I wanted to give an example here where you experiment with higher order models. So there's not necessarily a natural upper limit in terms of the maximum order of these models that will work, although as you increase the order of these Garch models, you might start to sort of run out of data and encounter numerical problems in the algorithm fitting. Now the point here is that the Garch 7.7 model might make sense in this instance because it would allow for the possibility that volatility over the previous week feeds forward and affects today. Okay, if you didn't have this interpretation, then really it wouldn't make much sense to fit a Garch 7.7 model in this case. So it's a hard model, it's pushing against the limit what you can reasonably expect students to do here. Again, you've got the same setup in terms of the R commands as we've seen before. So you've got the first step, which is the calculation step, and call it something logical, and you've got a second step, the summary step, to actually show you the explicit results of the calculation. R is like a robot, it won't do this unless you explicitly ask for it. So it says here, evidence of the arch effect from the statistics. The main thing to watch for here is, like when we had multicollinearity, you've got some redundancy in the model signified here by non-significant terms. So the t-statistics for this Garch 7.7 model are as follows, and I've said here we've got some evidence for the arch effect. So if you look at A1, this is significant precisely because the p-value is 7 times, which is less than 0.25. Again, it's in the table of t-statistics to show you, the reader, that this is significant. And what we have here then is some evidence of the arch effect precisely because this A1 term is significant. There's no other terms here that are significant, and merely this is a repetition of the scenario we first encountered when we had multicollinearity in the context of a regression model. So we've got non-significant terms here, and rather than that really being evidence against the Garch effect, what this is really saying is that the order of the model is too high, and I think that once you reduce the order of the model to something more manageable, then you would get a more precise estimation of the arch effect and the Garch effect. Okay, so the implication here is that a lower order model is appropriate. In terms of any assessment that I set, you would just need to be able to get this table of t-statistics and point out which of the coefficients that you estimate are significant. Here, the only one that's significant. I wanted now to give another example using Ripple data. So Ripple is another famous cryptocurrency. Historically, it was the second highest capitalized compared to Bitcoin, but has been recently overtaken by Ethereum. There was also some suggestion that recent cryptocurrency innovations by finance companies in New York may ultimately render Ripple obsolete. Okay, it's certainly interesting though to look at Ripple from a historical basis as far as cryptocurrencies are concerned. So again, wanted to do the same set of tasks in R. Firstly, reading the data, so this will be repetitious, and especially for the previous financial examples that you've seen. When you're doing this, make sure you've loaded the package T-series. So if the thing isn't working, this is the obvious mistake that you might have made. And then same set of instructions here. Firstly, fit a low order Arch 1 and Garch 1.1 models. So these would again have the interpretation of volatility from the previous day feeds forward and affects today. And the suggestion here is to experiment the fitting of a higher order Garch 7.7 model, and as it says there, this would again have the interpretation of volatility from the previous week feeding forward and affecting today. So in this case, all the Arch and Garch models with fitted have an interpretation in terms of the human calendar.